I would like Alejandro to give an overview of how the IMF is looking at the outlook for Latin America, and from then on we can start with some questions.
Perfect, thanks, and thanks again to the Council for having us again at the beginning of the year. I mean, using its great podium to lay out, I mean, our update for the economic outlook in Latin America in 2016. Let me first start, I mean, a couple of weeks ago we published our forecast for the world economic outlook. We basically downgraded just a bit our growth perspectives for the world. I mean, in terms of the major economic blocks, we're seeing a slight downward revision to the US economy, but we're still seeing the US economy growing at 2.6% in 2016 and remaining, I mean, one of the drivers of economic growth in the world. We didn't change our China forecast. The China team continues to believe, I mean, they were on the, let's say, more pessimistic side of the spectrum with respect to growth outlook for 2016. They continue to expect a growth of 6.3% in the Chinese economy this year, and they feel that, I mean, the transition from an investment-led, manufacturing-led growth model towards a consumption-led, service-led economy is, I mean, it's progressing as expected. Obviously, it's going to be a bumpy transition, and I mean, they feel that the authorities have the tools to accomplish this transition successfully, but obviously it will be a bumpy one. It will imply significant changes in the way things were done in China. And there's a significant challenge also in transitioning away from the state-owned enterprises into a more private sector-led growth in the service sector. And that's, I mean, showing in some of the decisions in the volatility that we are seeing. But I mean, most of all, I think the bottom line of their analysis is that they're seeing this transition to continue according to the original growth forecast. We're seeing Europe, I mean, having a very similar year as the one we saw in 2015. I mean, growth slightly above 1.5%. I mean, obviously at the beginning of the year there has been some slight increase in the concerns of these deflation risks coming back to the fore as the price of oil continues to drop, and maybe that generating some entrenched deflationary expectations that has driven the ECB to make some comments regarding the possibility of further expansions to the QE program. In terms of our main forecast, I mean, the main force that is driving down the world economy has been the deceleration in emerging markets. I mean, we have emerging markets have seen growth coming down year after year for the last 6 years, and this year, I mean, these downwards revision in growth obviously are being led by some emerging markets that are in the middle of a very difficult situation. And with that, I think it's a good moment to turn to Latin America. I mean, for Latin America, we're expecting 2016 to be the second year in a row in which average growth is going to be slightly negative, around minus 0.3%. The average obviously hides, I would say, let's say, 3 very distinct groups of countries. I mean, one distinction is between South America and Central America, Mexico, and the Caribbean. I mean, South America is the sub-region in Latin America that is most exposed to commodities, and therefore is the region that grew the most during the commodity boom, and now is obviously suffering the largest deceleration of these two groups. And within South America, we're seeing those countries in which macroeconomic imbalances and microeconomic imbalances were present together with the commodity boom. Those countries suffering much more in terms of growth deceleration and basically economic recessions now, because I mean, the unsustainability of their economic models have been called in question, and now they're engaging in important transition, crisis, etc. Obviously, these 4 groups of countries for which we're expecting negative growth this year are basically driving the region to an average negative growth. These countries are, I mean, first Venezuela, where we are expecting a minus 8% growth after minus 10% in 2015. Brazil, where we're expecting a year that in terms of growth is expected to be relatively similar to 2015, another minus 3.5% reduction in economic activity in 2016. Then we're expecting a slight negative growth in Argentina due to the transition. I mean, we are seeing the new administration in Argentina, I mean, basically describing the outlines of a sensible economic program. On the macro side, a path toward fiscal sustainability in the next 4 years. On the monetary side, the unification of the exchange rate and a transition to an inflation targeting regime with a floating exchange rate. On the microeconomic side, we're seeing obviously with the exchange rate a very important realignment of relative prices, basically the real exchange rate, but more than that, they're talking about realigning the prices of key utilities that were significantly distortionary in the last 10 years, and that, I mean, obviously will generate a major push to investment. And I think, I mean, there may be our difference with a government forecast is basically the point in which the economy is going to turn around. I mean, obviously, a transition from a consumption-led model to a growth model that will be based much more on the push coming from investment will generate, with the uncertainty that major revisions to the policy framework is triggering, might generate some adjustment, especially with the huge fiscal impulse that the economy had in the last few years. But after that adjustment, obviously a huge impact on investment, and eventually the economy will start growing at a positive rate. The government is thinking that this is going to happen in the second half of the year. I mean, maybe we're thinking it's going to happen a little bit later, but at the end of the day, I mean, qualitatively, we have a similar view. Quantitatively, I mean, the timing issue becomes an issue in terms of the number for 2016. And then after these three countries, I mean, we're also expecting negative growth for Ecuador. I mean, Ecuador is the second economy in Latin America that is most exposed to the decline in the price of oil as a share of its economy. After Venezuela, I mean, exports of oil as a share of GDP are the largest in Ecuador, and Ecuador obviously is facing, I mean, the great shock, negative shock of the decline in the price of oil, living with a dollarized regime while all of its trading partners are basically devaluing its currencies, and obviously suffering from the appreciation of the dollar, given that they have the dollar as their currency. So they have a very challenging time, so we're expecting a recession in 2016 in Ecuador as well. Then we have the countries that are adjusting to these negative terms of trade or shock in a smooth and normal way. I mean, Chile, Peru, Colombia, etc. Each of them with different timing depending on the commodities and some domestic differences. Colombia slowing down later on, given that it's much more exposed to oil than minerals, and Chile and Peru suffering the slowdown before. But all of these countries, I mean, basically growing in the range between 2 and 3%. Basically, we're expecting for Chile and Colombia for 2016 to be very similar years to 2015. In Peru, we're expecting some increase in growth to, let's say, to a range around 3.5%, basically because of positive supply side effects. On 2015, they were also negatively affected by fisheries, etc. But more than that, in 2016, some important mining projects are coming into production. That they already came into production, some of them at the end of 2015, and that is going to help, obviously, the economy to pull through. And just to maybe to close down, I mean, some mention on Mexico. I mean, Mexico, first of all, I think it's important to make the clarification that Mexico is no longer an oil country. I mean, when you look at net exports of oil, these are almost zero, sometimes are slightly negative, sometimes are slightly positive. Mexico exports crude, but imports a lot of refined products. So from the economy as a whole, Mexico is not an oil exporter. Obviously, the government has exposure to oil in its fiscal balance, and it basically has announced a gradual program of fiscal consolidation to basically compensate for the drop in the price of oil. On the other hand, it's tied very strongly to the U.S. and the manufacturing sector in the U.S., to the automobile industry in the U.S. that is doing very well in the last, let's say, 12 to 18 months. And also, after a very long period of very subdued domestic demand, we are seeing the Mexican consumer start to be a little bit more reassured of their financial position, of their balance sheet, etc. And we're seeing domestic demand in Mexico to pick up and investment to react to the structural reforms both in oil and in telecommunications and obviously peripheral sectors to this. And therefore we expect with a US consumer that it's maintaining a strong pace of consumption, with the manufacturing sector in Mexico doing relatively well and benefiting from the depreciation of the peso, the low prices for energy, etc. And the more gradual effects on investment from the structural reforms, but important effects coming from both in telecom and oil on investment. We're expecting the Mexican economy to show a slight acceleration into 2016. And basically we're seeing an economy that is driven by very different forces than many of the other large economies in Latin America. I would say the main challenge for Mexico is how to grow sustainably at a higher pace. I mean, they move on this front very aggressively at the beginning of this administration with the structural reforms, and I think the big question is if these reforms are enough or something more needs to happen in Mexico to see Mexico growing sustainably at 4. We at the fund think that more needs to be done, but this has been a very impressive set of reforms for the first 3 years of this administration. Now the implementation phase will be key, especially facing some headwinds in an environment of low prices of oil, especially for the energy reform. But with that, I think it's a good time to open up the discussion that you have prepared.
Thank you, Alejandro, for this great overview. And I think it's telling that Alejandro started the outlook for Latin America talking about the US and China, right? It's such an open region that the global context is critical for it. And on that note, I wanted to ask you, we had 2015 dominated in Latin America by concerns about the deceleration in China, how that was impacting most of the commodity exporting countries of the region. And this year comes 2016, and we had a lot of financial turmoil coming from China. What is worse for Latin America?
I think, definitely, what happens to the real sector in China is much more important for China and for Latin America. Even for China, although the volatility that we have seen in the stock market is important, still the stock market in China does not play such an important role in terms of being a driver of consumption through wealth effects, etc., as in developed economies. And still the stock market is significantly above the levels that the stock market had in China 18 months ago. So still, if you look in terms of net wealth, there's still an important effect on the Chinese consumer that should be positive and not negative vis-a-vis 18 months ago. But more than that, I think even from a Latin America perspective, the stock market does not represent a major driver of consumption or investment in our countries as it does in the developed world. And therefore, for the region, it's much more important what happens to China, both in terms of growth and the composition of growth. And there, I think it's very important from the short term. Obviously, this distinction between investment and consumption. Obviously, a lot of people have spoken about, those countries that basically are mineral producers suffering more from the decline in investment in construction or the deceleration of construction investment, etc., in China, being more intensive in minerals. And obviously, those countries that export agricultural product not suffering that much from the decline in growth in China, given that to the extent that consumption will continue to exhibit an upward phase in terms of growth, and the whole transition in China implies or will imply an acceleration in consumption, that should bode well in relative terms for agricultural producers. That does not mean that agricultural producers are going to see an increase in their export prices, but the decline in their prices, in their export prices, is going to be much less than the decline we're seeing we have seen since 2011 in the price of copper, in the price of iron ore, etc. And the last leg of your question, in terms of financial turmoil, maybe has at least two dimensions. One was the depreciation of the yuan, and then the fears of further depreciation. That, to the extent that it's part of a policy response that will sustain growth in China, I think should be, when the dust settles, positive for Latin America. Obviously, when the initial movements take place and people do not know exactly when it is going to stop, it generates a lot of volatility in currency markets, a lot of uncertainty, and therefore an attitude of wait and see in terms of important decisions, investment, etc. But I would say that the only country that is, let's say, a major competitor to China, and therefore competitiveness issues play a role in an environment in which there are some concerns over real exchange rate depreciation in China, is Mexico. And I think Mexico has opened up such a huge real exchange rate advantage vis-a-vis China in the last 6 years, that the magnitude that is being talked about in terms of what could be the potential depreciation of the yuan is relatively small vis-a-vis the real exchange rate depreciation that the Mexican peso has had vis-a-vis the yuan in the last 7 years, and therefore I don't think it is that relevant. It is relevant when it generates volatility in the markets, but per se the movement in the currency should not be that relevant. The other important financial issue, obviously, that we all had a lot of concerns about was the first move by the Fed, and obviously the potential that the first move in interest rates in such a long period of time could have created a sudden outflow of capital from Latin America that had received a significant amount of flows of both FDI, but more than that, financial flows in the last 6 years as a result of the low interest rate environment and as a result of the search for yield from many investors. In addition to that, I think there were a lot of fears created by the episode that was called the taper tantrum, and therefore people were expecting that maybe a similar episode could happen. I think, this has been telegraphed for so long by the Federal Reserve that when it happened, it was a non-issue. And I think going forward, more than the movements in the Fed per se, that I think it has been communicating in a much more open and transparent way its intentions. I think the key issue now in the markets is kind of how this gap between what the Fed hinted that it was going to do in 2016 in terms of 4 movements of interest rates, and the market expectations that markets were expecting 2 movements throughout the year, how that gap was going to close, and the potential that economic information, basically regarding expectations of inflation, expectations of growth, etc., might affect that gap and generate other surprises in the market. But I think, to the extent that we're seeing an initial phase of the year in which volatility has dominated and expectations of Fed movements have moved downwards, and people have postponed the timing in which they expect the next Fed movement to happen, we are seeing that in that front, maybe the Fed will not be such an important driver of news as news coming from China for the region during 2016.
Okay, Alejandro, it looks like you are a lot more concerned about potential shocks from the real channel to the region than through the financial channels, be this from China or the Fed tightening. If you were some god protecting Latin America and to try to ask for some precision on the question or an order of magnitude of how the concern varies from real to financial, if you were able to determine one thing, how many basis points of Fed rate hikes would you trade for a 1 percentage point deceleration of China? And is this the same for all countries in the region, or would you change that?
I won't answer that question, because every time you answer that question in a relatively concrete way, you're wrong, no? And exposed, you're proven wrong, and it's very hard to assess that trade-off. For example, the analysis we have made at the fund with respect to Fed tightening, to the extent that Fed tightening comes together with a U.S. economy that continues to grow in this range between 2.5% and 3%, or between 2 and 3%. That should be good. Let's say the combination of Fed tightening and a U.S. economy that is doing relatively well, that should be good for in Latin America, all the way from Mexico to Colombia in general. Then the combination of increases in interest rates with a U.S. economy that is doing well should be marginally negative for the rest of the Southern Cone, given that they have less real ties to the US, and they obviously have strong financial ties as well. But I think that, in terms of order of magnitude, it's still relatively minor vis-a-vis China. And the analysis we are doing in this case is an analysis in which we are expecting smooth Fed tightening without market volatility. So if you tell me, okay, we have an episode in which we see a repetition of the taper tantrum that lasts half a year, that can shave off some basis points of growth in Latin America and could be a little bit more serious, because that will affect investment, that will affect consumption, and through uncertainty can generate some real effects. But if it's a gradual tightening of monetary policy in an environment of a strong US economy, I think it shouldn't be that complex for the region to handle. On top of that, and I think the difference in the way some central banks have dealt with this issue shows you which countries are more exposed to this financial volatility and more concerned. I mean, if you take, although in our analysis, Mexico seems to be one of the countries that should fare much better with Fed tightening and the US economy doing well, it's the central bank that is most concerned about Fed tightening. And that's because the Mexican financial market is the most integrated and the more open to the international financial markets. And therefore, people have used Mexican markets as like a synthetic way to hedge the risk in other less liquid emerging markets, and therefore volatility has been exacerbated by this phenomenon. And that's why the Central Bank of Mexico, although seeing the lowest inflation in history, the lowest inflation expectations in history, an economy that is doing well but is not booming, has decided to tighten with the Fed just to tell investors that they will do anything in their power to minimize excessive volatility coming from Fed tightening. Maybe Colombia is a country that has some of these effects due to the fact that the Colombian sovereign debt in local currency was included in the main financial indexes a couple of years ago, and that generated a significant inflow of money into the local market. And therefore, we have seen some excessive volatility together with the normal volatility coming from the reassessment of fundamentals in Colombia due to the decline in the price in the price of oil. So I would say, and on the other extreme, we have Chile, that it's a country that, for its degree of openness, has a small presence of foreign investors in its country. So the behavior of their capital markets is much more similar to what we're seeing in Canada, for example, than what we're seeing in Mexico. We're seeing, a lot of exchange rate depreciation, etc., but the yield curve does not move that much with all this news. When you look at the taper tantrum reaction, the yield curve in Mexico steepened a lot. In Chile, it didn't steepen at all. It was just the usual textbook effect that you will expect of the exchange rate being the main buffer, but local financial conditions remaining steady. So I would put Chile at the other extreme. And obviously Brazil being a country in which it's very hard to distinguish when you see how the markets react to a news, whether it's domestic factors or external factors. Brazil is suffering from external factors, but obviously the deepness of the crisis reflects domestic conditions, reflects a significant disequilibrium that the economy had at let's say the initial phases of 2015 in terms of its external accounts, inflation, fiscal balance, and important macroeconomic distortion. And that, starting, let's say, in the second quarter of last year, got complicated with a significant political crisis, and obviously the effects of the corruption scandals in Petrobras affecting not only the energy sector, but also all the chain of suppliers to Petrobras that were involved in this in this case, that suffer a significant liquidity shock, and therefore investment is suffering way and beyond what is explained by the decline in GDP, given the additionality of uncertainty coming from political uncertainty and from the corruption probe in the oil sector.
Mm-hmm. Okay. Well, sounds like it's a very tricky context for Latin America, primarily from China then. One thing that is noticeable in the policy response of Latin America to that context is that, in contrast with the 2008-2009 crisis, in which all Latin American commentators were praising the region because it seemed that it had liberated itself from its emerging markets framework, now comes 2015 and all the countries are in adjustment mode and central banks are tightening rates. What accounts for this policy shift, and is this the right policy shift?
I think, two things. In 2008 and 2009, Latin America was clearly shocked by a negative external shock. This shock ended up being transitory, and the conditions with which Latin America arrived at that shock were much stronger than the ones we're seeing now. So in that sense, for example, if you take the case of Brazil or the case of Chile, etc., all of these economies saved not as much as one would have wanted, but did some savings from 2003 to 2008. So debt dynamics, when you look at public debt dynamics, were positive. Debt to GDP was declining. Inflation was coming down, and the level of leverage in this economy, in these economies, was relatively low. Then these economies get shocked by a negative external transitory shock. So the right response is to go ahead with aggregate demand policies, both monetary and fiscal policies, to smoothen this negative shock in this economy. What we're seeing now, first, let's look at the external shock. It is negative, but it's not transitory. It's big. And both of them, China is decelerating, hopefully, to a long-term sustainable rate that it's lower than what we saw in the previous decade. So it's going to remain there, and it will be the new normal situation that these economies will face. And therefore, you cannot count on a new commodity boom saving the region. And basically, you can count that maybe some of the adjustment in commodities that we're seeing now are exaggerated by financial conditions, etc. But at the end of the day, commodities will not go back nearly to the peaks that we saw before. On the financial front, conditions remain loose for emerging markets, but are going to tighten. And that's why, this has been called the normalization of monetary policy. It's not temporary. It's going back to what should be normal. And in that sense, the interest rates in the US are going to go from 0 eventually to some level between 3 and 3.5 in the medium term, and the region has to accommodate for that. And on top of that, the region is not as healthy as it was in 2008. A lot of countries embarked in important counter-cyclical efforts, both mainly from the fiscal side, and in the case of Brazil, also from their development banks. So they use up whatever space to counter these negative shocks with leverage, responding to that shock. In the case of Brazil, maybe they overdid it, and they continued doing it when the slowdown in the Brazilian economy was no longer explained by the external shock. So now, the markets have focused in some aspects of unsustainability in some Latin American economies. So it's important to correct the causes of that unsustainability. In the case of Brazil, you had a typical diagnosis in the short run of an overheated economy. A current account deficit that had widened and was relatively large. Inflation going up, and debt dynamics just continue to increase continuously. That had to be corrected by tightening monetary policy to contain the inflationary burst, tight fiscal to contain the increase in debt and to contain the current account. And then the Brazilian economy faced another problem. There was low growth. But low growth in a situation in which the country was at a historically low unemployment rate was signaling that the problem of growth was coming much more from the lack of investment and the lack of productivity, And therefore, to tackle the long-term growth problems of Brazil, you have to basically work in generating the conditions for investment to come back and for productivity to come back. So although Brazil is maybe the most extreme or an extreme example of this, I think the program put together by the second term government of the PT of Dilma Rousseff in terms of doing a fiscal consolidation that would happen in a period of time, monetary tightening, realignment of relative prices in the utility sector, etc., was the right one. Mm-hmm. But now I think the complication is the implementation of this program in an environment of political uncertainty. Mm-hmm. When you look at countries such as Chile, Peru, Colombia, basically in Chile, Peru, and Colombia, you're still seeing some fiscal support in an environment of subdued growth that basically is helping these countries to smooth the adjustment from rates of growth of 5% to rates of growth in the range of 2.5% and maybe 3.5%. But it's basically not the fiscal impulse, it's not something that can be sustained forever. It's basically helping the economy to smooth that adjustment. And finally, on the monetary policy front, I think a lot of these countries and a lot of these central banks have done a lot. I mean, currencies have depreciated between 25 and 60%. That is going to help to shift gradually this economy to a more diversified production structure. But this will take time. These depreciations happen in an environment in which inflation really did not pick up that much. It picked up a little bit, but the pass-through from depreciation to inflation has been relatively low. And also, the central banks maintain interest rates unchanged for a very long period of time. What is happening now is that although the pass-through to inflation is low, the depreciation has been relatively high, and therefore inflation in Colombia, in Peru, in Chile did go up. And given the concern that this temporary increase in inflation might feed into long-term inflation expectations and therefore into wage setting, etc., central banks have tightened to avoid the entrenchment of inflation expectations. But if you look at the combination of interest rates and exchange rates, I would say that still the monetary policy stance is supportive of the economy. They're only facing this challenge of avoiding second round effects from the depreciation to inflation, and that has led some of these banks, of central banks, to tighten monetary policy.
Well, it sounds like the region gets a good grade in the policy response then. But you also mentioned that to tackle long-term growth, the region should undertake other types of policies and reforms, which is something that resonates with something that Alejandro has said in a blog post of the IMF in the blog Diálogo a Fondo, which I take the opportunity to recommend, which is very good. And I was wondering, before I open it up for questions from the public, whether there are specific reforms that you may want to highlight that you have liked or that you could recommend in that vein to boost long-term growth.
Okay, I think there are two things. I mean, the region has reacted well to the current situation, but we do have, I mean, a subset of countries that are still struggling to adjust to the current environment. I think, obviously, the situation in Venezuela, in which we have highlighted that inflation is basically unanchored. We are expecting inflation this year to be north of 200% in 2015, and in 2016 we're expecting an inflation rate that can be north of 700%. We still estimate an economic contraction of 10% for 2015. We don't have the numbers for the full year yet. And we're expecting similar contraction of 8% in 2016. So the productive capacity in this economy has collapsed. I mean, if you look at private sector investment in this economy, is nil. So this economy is going through a very tough period, and it's if you look at the largest economies in the world, I mean, you take the largest 60 economies in the world, I mean, Venezuela is the one that is contracting faster and is the economy in the world with the largest inflation. So there you have, I mean, an important economy in Latin America facing significant challenges. Brazil also, what I mentioned is Brazil announced what we thought it was a good program, and I think a lot of people thought that way. But now it's in the middle of a very difficult political situation that has impeded the implementation of this program. Therefore, we do think it is important that the political system eventually delivers an environment in which this policy response, with whatever adjustments, etc., can be implemented to provide some trust that the economy is going in the right direction, and this will start changing a little bit the negative effects that we have seen in 2015. As I mentioned, I mean, Argentina is in an important transition towards a more market-friendly model in terms of macroeconomic regulation and a more sustainable macroeconomic policy, and that should bode well for private sector investment. If we look in the last 2-3 years, private sector investment as a share of GDP in Argentina has declined by 2.5–3%. So there's a lot of scope for, with the normalization of policies, an important recovery coming from the investment side. In terms of structural reforms, I think what it's important to recognize is first that the region it's in for a period that it's not going to be a short period of low growth. I mean, we won't be seeing negative growth. We should not be seeing 1% growth. We should be seeing growth in the range between 2 and 3% in the region. I mean, so coming back to those levels. But very hard to think in the near future that the region could be showing rates of growth of 4.5–5%. For that, you need, I mean, a region that invests much more, that saves more, and that has a much higher increases in productivity than what we see now. I mean, obviously, reforms such as the tax reform and social security reform that took place in Colombia a few years ago, I think are important elements of a policy package. I mean, obviously, the structural reforms that we saw in Mexico in telecom and in energy are very important to boost investment in Mexico. I think the education reform that took place in Mexico is an important reform when you're looking a decade forward. I would say that the case of Chile, in which a fiscal reform was implemented to undertake a significant social and structural agenda on the education front, etc. It's important. I think there has been a lot of discussion of the details of these reforms, and I think both on the tax reform and on the education side, there are a lot of critiques exactly on the instruments that are being used. So what I'm saying is just the objectives of these reforms we think are the right ones. I mean, maintaining sound public finances, get public sector resources in a country that has a low tax base to fund an important push for education, and an economy in Latin America that has reached the upper level of the range of middle-income countries, and basically is looking for a burst of growth that should be much harder to achieve as you go into high-income levels. I think that's the right approach, but again, the details are important. I think the World Bank has done important work on education reform in Ecuador, and they have highlighted that when you go down to the school level, very basic things on how you address students, on how you incentivize professors, etc. Ecuador is doing right things on the educational front. But it's hard to see a country in which you see institutional reforms, administrative reforms, let's say in the area of infrastructure, etc., that can really change the growth path of the economy. And I think it's a little bit the reflection that we are living in most of the Latin American countries in much more modern and true democracies, and therefore discrete changes do not happen in democracies and democracies in which you have important income disparities and still significant ideological differences. So all of these achievements that we see in Mexico after 25 years of discussions of opening up a key sector, it's an important task. I mean, in Chile, the discussion of how to reform education. In Colombia, tax reform, together with the social security reform that basically reduces how you tax labor in that economy. I think they're all important aspects, but I mean, recognizing the political economy nature of what the region needs to do, it's going to be a gradual process that will build up through time, eventually to sustain higher rates of growth. And I think the other important political economy issue is how, in this process, with a larger middle class that will be demanding more public sector services, you can maintain macroeconomic stability while you work on the fundamentals of future growth that will not manifest themselves immediately. Mm-hmm. So I think the political challenges will be very important, and it will be a very challenging 5 years for Latin America, those that we're entering now. Mm-hmm.
Well, very insightful. And there are about 13 minutes left until we reach the final time of this conversation. So I would like to open the floor for some questions, and perhaps what we could do so that more people have the chance to ask is take 3-4 questions from the floor, and perhaps a couple of questions from our press visitors, and then give Alejandro a chance to answer. Yes?
Will Venezuela default on external obligations in 2016? And what are the incentives that China has to come to the rescue when oil is trading at 30?
Anybody else there? Mm-hmm. Feel free to introduce yourself and your institution if you like. Yes, please.
Hi, you talked about China as some, the commodity collapse is hurting Latin America. Can you talk about China as a source of investment for Latin America? And China recently in May, I think, announced plans to study a project of a train from Peru to Brazil. That sort of is emblematic of its investment in the region. How important how much does Latin America need China as a source of investment to continue to grow?
There are a couple of questions here. Sir. Yes. Yes, please.
Well, thank you very much. I'm Jean Ergos. I'm Chief Economist of Tigris Financial Partners, and I teach at NYU. We've been covering a lot of commodities, and I worked in this for many years myself. And I'm just wondering, what do you think could be the outcome of this commodity? First of all, I don't believe there's going to be a commodity boom. I think, in fact, that a lot of countries were expecting to manage a decline. They were not expecting to manage a crash, which is what actually happened. But to what extent, how far are we from the break point for the solvency of certain Latin American countries in terms of commodity prices? Because I think commodities are systemic, quite frankly. And we're seeing cash burn rates on reserves in a lot of countries. Reserves are just being eaten up. So you mentioned previously, in fact, that a lot of money has been spent in 2008, 2009, but the financial position has become somewhat thinner. So I'm concerned on that front.
Answer, please.
Andrew Qualley, Sidley Austin. The French economist Alain Ray has criticized Fed policy and indicated that the quantitative easing has caused enormous volatility, particularly for developing countries. And she's recommending capital controls and is preaching her religion around parts of Latin America. My experience has been that's it's not good, and that we should be concerned about that. But I'd be curious what your reaction to that is, and also put it in the context of a country like Colombia, which has really done a very good job, but has had an extraordinary depreciation in its currency. And whether they should be tempted, and even if they're not tempted, which might be good, why has Colombia suffered so much being such a good actor generally. Thanks.
Alejandro?
Okay. So with Venezuela default and incentives for China, I would put that question together with how many basis points would I trade for China deceleration. So let me, take it from a more qualitative point of view. Venezuela has clearly shown its willingness to pay. I think, several economists, Ricardo Hausmann among them, some months ago or years ago were questioning why, the government, given that it had defaulted on everything else in terms of, providing public services, et cetera, was not defaulting on debt. So I think in terms of the willingness to pay, it's there. The key question now is that, given the surprises coming from the decline in the price of oil, is actually, financially they will not have the resources to pay their debt. And how much more can they squeeze consumption of their population to continue to service its debt? Truly, I think that's it's a very important question for those of you that are holding Venezuelan and PDVSA debt. The true question is how you fix the Venezuelan economy. At the end of the day, the relevant issue now is no longer the payment of the next coupon. That will be maybe the manifestation in international financial markets. But Venezuela debt is trading at default levels, etc. So the most important issue, and I think the Venezuela debt is being held by distressed investors. So it won't be a surprise in financial markets. It will not be an unexpected shock. So it will be just the manifestation of what we were all expecting many months ago. So in that sense, the most important issue is an economy that is contracting at a rate we expect of 18% cumulative in the last 2 years. You can say 15, 16, 22. It's an economy that it's imploding and that the effects on its population are very dire. Consumption has significantly contracted. Scarcity of primary products is at around 50%. Health issues are extremely important. So I think you have a very important social dimension to this crisis that eventually has to be corrected. And in that sense, again, it's a situation in which, from an economic point of view, you can find several strengths to the adjustment that the Venezuelan economy has to do. The Venezuelan economy is not facing an external crisis. It doesn't have a current account deficit, so it does not need, it already did the absorption adjustment that an economy needs to do during a crisis. So what you need to do now is to adjust the public sector, given the huge decline in income that it has faced, realign relative prices, and try to re-establish a market economy, rebuild institutions, etc. And I think the moment will come when politically Venezuelan society eventually generates some transition that allows them to implement these policies. And I think it's very hard to envision a situation in which, with the current policies, you will not avoid default relatively soon, and you will not avoid the intensification of the social pressures that the Venezuelan society is facing. The situation was already very dire when the price of oil was at 110. Now with the price of the Venezuelan mix below $20 per barrel, I think socially it's completely unsustainable. China as a source of investment, I think China has been an important source of investment for those countries that had important challenges on their macroeconomic and microeconomic management. When you look at the case of Venezuela, when you look at Argentina before this change, they needed a marginal investor and a marginal financial safety net, and China was there to support these countries. The same is true in the case in the case of Ecuador. I think on the one hand, without understanding the logic between Chinese financial deployment, I mean, there's interesting projects in Latin America to be undertaken, and obviously China is an economy that has significant excess savings. It has excess investment at home, and it's suffering a significant slowdown. So there's a significant incentive for China to export capital and labor to the region. I think that also China is seeing a political transition in the region that at least makes them think of under which governance you want to undertake this lending. And I think that also has happened internationally. I mean, in a sense, you have seen China starting to create the institutions and the governance under which you will provide this financial exposure under a much more disciplined umbrella. I mean, the creation of the Development Bank of China, the BRICS Bank, etc., and basically trying to set up a governance to provide a little bit more discipline to this deployment, I think is showing both things. One, that a policy that maybe started with a lot of discretion, once that it grew, they decided that it needed a stronger rationale. And on the other hand, I think they also realized that, I mean, some of these projects or some of these lending facilities ended up in very unstable political destinations. And therefore, even if this lending has a geopolitical dimension, it has to be done into nations that are politically sustainable. No? And I think that might generate a change in the way this financing is undertaken, and I think that's a little bit what we're seeing with the creation of these new institutions in China. And how much does Latin America need China to grow? I think it was more at the margin. How much marginal lending could some economies in Latin America get from China to continue to support policies that were not growth enhancing? I think at the margin what we saw is people turning to China when they did not have a growth model to sustain. I think at the end of the day, in today's world, if Venezuela opens up and has a stable and regulatory framework for their energy sector, we will continue to see a lot of international interest in their industry. And China will be an additional player, but they will have many other players competing for their projects. The same is true for infrastructure. Even today in Latin America, I mean, Mexico has launched the new airport in Mexico City, a huge investment project, and I think there's a lot of interest to be in that project. I mean, Colombia is in the middle of what they call their 4G projects, that it's basically toll roads throughout Colombia. I think there's a lot of interest coming from all over the world, including China, in those projects. So I think it's more an issue of having the right governance, the right institutions, and obviously, yes, approaching China to the extent that your regulation, your institutions have to accommodate some institutional idiosyncrasies from China, you better do it, because they're a big investor, and you should accommodate to them as we have accommodated in the previous 40 years to some issues that were characteristic of an Anglo-Saxon legal system, etc. That's where the money was coming from. Now that the money will be coming from, in addition, from Asia and from China, I think we need to do within our governance what is sensible to attract those investors. But I think both sides are changing, and I think we will continue to see important flows. They will be more geographically diversified, not only concentrated in Venezuela, Ecuador, Argentina, etc. And the region will look much more to China because it's a long-term relationship that they have to build, and it has to be based on sound footing. I think solvency of LATAM to the commodity collapse. Again, I think those countries, I mean, Chile, I mean, now my numbers might be a little bit mixed up, but Chile is one of the top 3 countries in the region that it's most exposed to commodities. And Chile is perfectly handling this commodity shock. I mean, obviously, for Chilean society that was used at growing at 4.5%, 5%, growing at 2% is a challenge. But there's no solvency problem in Chile. There's no financial collapse in the making. I mean, the Chilean economy is doing okay under a very severe external shock, and under important political discussions that are taking place regarding in which direction they want to structurally organize their economy in some key sectors like education, etc. But from the point of view of solvency, I would say there's no problem. I think the same is true in the case of Peru. The same is true in the case of Colombia. I mean, these countries have been able to manage the decline in the income coming from commodities, both from a private sector side and from the public balance sheet. From the private sector side, saying that they are managing this issue does not mean that there will not be problems. I mean, obviously you have a lot of corporates exposed to commodities. There will be workouts. A lot of these corporates were flooded with money in an environment of 0 rates and high commodity prices. Maybe they overextended themselves. Maybe they launched projects that under the current prices do not make sense. So there will be corporate issues. They will be worked out. And I mean, obviously we will see. I mean, these are economies that were growing at 4.5 that will be growing at 2-3%. These are economies in which the real exchange rate depreciated a lot. Interest rates are going up, and therefore there is a lot of leverage that will need to be worked out, or some leverage. But I think that will take place in many of these countries in a normal fashion. Then you have countries like, I mean, Brazil. I mean, I think the issue in Brazil, it's not an issue of an external shock. It's a domestic issue in which both through their fiscal accounts and their quasi-fiscal accounts with their development banks, Petrobras, etc., they overexpose themselves. And now they're trying to, they need to manage this fiscal crisis in a tougher environment. But I wouldn't put the whole onus of this problem on external factors. And in terms of the commodity decline, I think countries that manage the macroeconomy relatively well and have a sound financial system are still well positioned to manage the commodity shock. Obviously, will generate problems on the real sector of the economies, etc. Then going to Helen Ray's argument on capital controls, etc. I mean, there are other people that have made counter arguments to Helen Ray's papers with respect to the lack of monetary independence in the face of huge capital controls. Among them, I mean, Maury Osfeld wrote a paper, I mean, saying, yeah, I mean, central banks lost part of their influence to affect the long part of the curve, because you're seeing a lot of flows coming to that part of the curve incentivized by the decline in long-term yields in the rest of the world due to QE. Yeah, this is true. This is another shock that affects the yield curve. I mean, in the US, you had what I think Greenspan called this conundrum, that even when he hiked interest rate in the short part of the curve, the long end was not moving because there was a lot of money coming from other parts of the world. Yeah, it's true that there are other factors that affect your yield curve. In the last 5 years, those factors were extremely powerful, and you had to manage them. I mean, obviously, our preferred tool would be macroprudential policies that really avoid these flows to be intermediated in a very distortionary fashion through your financial system. We also think that with a truly floating exchange rate and an inflation targeting framework, you're a long way to managing those flows. We did say a while ago from the fund that within this toolkit, capital controls to weather the effects of the inflows could be part of this toolkit. But I think this should not be a blanketed recommendation, and countries should target their policies to their specific idiosyncrasies. I mean, you have countries like Mexico, Chile, and Colombia that are super opposed to capital controls as part of their toolkit. And they have defined themselves and their macro and financial markets as markets in which they're extremely open, their framework is extremely well communicated, and I think with a 95% probability they think capital controls is the wrong tool, or it's impossible to impose them in such open economies, and whether even if they think with this 5% probability that it's a good tool, they think it's not good for us because it will generate so much uncertainty regarding my whole model. I have branded myself as an economy that it's open, etc., that investors will extract the wrong signals from this step. Other countries might use it as one of the tools, but I think the temptation sometimes to use capital control as a substitute for good policies might eventually be very high, and that can generate a lot of problems. So if some of them are put within a context of sound policies and sound policy response, I think it is worth discussing about them and engaging in this possibility. I think they should not be used as a substitute to doing the right adjustment to accommodate to the new environment. But I think at the margin, we do have to recognize that we have gone through a very atypical period in world financial markets history. These differences will continue for a while, and we have to be open to discuss some of these possibilities, but I think they're no substitute to the correct implementation of macroeconomic policy. And I think I will just end and link this to the previous question and more from the private sector side, that there is a concern that, I mean, Latin America received like $700 billion of flows into its bond markets. A lot of that dollar denominated, a lot of that into companies in the commodity space. So in the private sector, there's a significant leverage that will have to be worked out. I mean, part of these are the quasi-sovereigns, the Petrobrases, the Pemex, etc. Part of that are the Vales, other commodity exported. But part of that also are some construction companies, etc. I think a large part of these companies will be able to survive the current environment. They will continue doing their business and they will continue servicing their debt. But obviously the combination of financial turmoil, slowdown in their economies, depreciation of their exchange rate will generate, I think, a period in which a corporate balance sheet management will be hinging on the recovery of investment in the region. I mean, when you have a significant chunk of your corporate sector that is working through some leverage issues, this is not the best environment to be thinking of new projects, new investments, etc. So it will be important for these countries to have the right tools to manage these leverage issues. I mean, we have, this construction company, ICA, entering into restructuring talks in Mexico. We had the home builders in Mexico also going through an important restructuring. But this is not holding back the Mexican economy, and this is part of a market-based economy that is suffering some shocks, and the economies have to have the right institutions to handle this leverage problem, and I think many economies in Latin America have them.
Thank you so much, Alejandro, for this insightful conversation, and thank you to the audience and the Council of the Americas for making it possible. And with that, I think we can thank Alejandro with a round of applause.
Thanks.